Today I'm back in Eastern Shores here in Miami, and we're on the corner of Northeast 34th Avenue and 164th Street. There's a bunch of these little inlet roads that come in here through the neighborhood. Some of them are a little bit flooded out, like this one here. Just had a huge rainstorm here. So I'm just gonna walk down the road, see what we see. We've never been down this way before, ever, first time. So let's check it out. Now today there was actually a little bit of an encouraging piece of news, if you ask me, when it comes to what people are thinking and feeling towards the housing market right now. Because so many people have been FOMOing into the market over the past few years. Well now, according to a recent survey, about 2/3 of Americans are saying that they're not going to be interested in buying a house until interest rates start coming back down. Now, even though this part of the data might be encouraging that people are holding off until interest rates come back down, it reveals a couple things. One, that everyone still is relying on interest rates to get the best deal rather than the best price, which is not a good thing. It shows the ignorance of the average person buying in the market. But also the other problem with it, in general, when interest rates come down, prices usually go up. But under these circumstances, likely what's going to happen is when interest rates do finally start falling, it's likely going to be because there was a Fed pivot. And if there's a Fed pivot, it means that we're in big trouble. So this time around, it is going to be different. So it'll be interesting to see how it's going to go this time around when interest rates finally start dropping. Is it going to follow the historical norms and prices going to go back up? Or are prices going to continue to fall even with interest rates falling? However, there's a lot of people that took this survey that are rethinking their home buying plans entirely. It turns out that 43% of respondents say that they're no longer sure when or even if they'll ever be able to buy a home. That's almost half, guys. And under these current circumstances, I can see why people are thinking and feeling that, because like we've talked about many times before, when you have a median house price hovering near the 400K mark and interest rates are at 7%, you need to be pulling in well over 100 grand a year to be able to qualify and buy one of these properties. Only 6% of the people surveyed said that they plan on buying a house this summer, and 4% say they plan on buying in the fall. 32% say that they will wait until 2024 or later to enter the market. And the most troubling part out of all of this is that housing costs is becoming the most significant source of financial anxiety for 68% of the people that took this survey. And the only thing that's causing more financial anxiety than the cost of owning a home right now is the economy, believe it or not. 83% of these respondents saying that unknown expenses are their largest source of financial anxiety right now. And how can you blame people, guys? Like, literally everything is getting more expensive out of the blue. Like, we knew inflation was here. We knew that things are going to get more expensive with inflation, but some of the things can just hit you like a gut punch, like these insurance rates that are doubling or tripling for people, having a major expense that costs double what it did a few years ago. Say if you need to get a new roof done or a new air conditioner, all these things are far more expensive due to inflation as well. And those are surprise expenses, things that you're not really planning on happening, or getting a new car, things like that. And by the way, this survey was done from the Real Financial Progress Index, which is a forward-looking indicator of consumer sentiment regarding personal finance. So when you look at this, most people are not feeling too good about the economy and the future right at this moment. But I think there is another positive to this, and that is that people are finally waking up and being cautious, because when you have that many people worried about surprise expenses or the cost of housing, people are likely to make more careful decisions. They're not going to be going out and getting into bidding wars for the most part, and they're not going to be going out paying over asking price for houses and the other ridiculous things that people have been doing that make no sense. Because if everybody's worried, they're going to be more careful from now on. And I think caution right now is probably the best secret weapon you can have, because there's so many unknowns moving forward. We don't know what's going to happen with the housing market. We don't know what's going to happen with this banking crisis. We don't know how bad and how long the recession is going to be. You know, there's so many unknowns right now that can really shift the direction of things pretty quickly. Just being a little bit more cautious about your financial decisions right now can really take you a long way, if you ask me. Now, here's something I've been covering on and off when it comes to renters, and this is really good news for renters. In fact, there is a historic amount of new rental apartments opening over the next 18 months in just the US, guys, and that amounts to 950,000 rental units that are going to be coming online in the next 18 months. That's almost 1 million new rentals in a year and a half. That is very good. And there's going to be so many new rentals coming that multifamily unit owners in some of these Sunbelt cities that are getting most of these new rentals are actually seeing, you know, declines in vacancy as well as rental prices because of so many new units coming available online. In fact, Atlanta here is used as the star example because rents there have already flattened out, and it's predicted that Atlanta is also going to see a decline in occupancy rates with so many new units coming up in the area. And it turns out that so many new rental units is also having an impact on the value of multifamily units as well, because multifamily buildings right now fell 12% from year-over-year levels. So a year ago, these buildings were worth 12% more than they are today, which is a pretty significant drop, okay? I think that when you're going to see a 12% drop in 1 year, that's equivalent to what we're seeing in some of these big cities that are having their housing crash right now, like Austin, Texas, San Francisco, you know, Phoenix, Arizona. These places are down by double digits year over year as well. And this is now starting to bleed into the multifamily. Next is going to be commercial real estate coming whenever the wave of defaults come. In places like Phoenix and Las Vegas, rents are coming down now. People are also less likely to spend more money on a more expensive rental right now due to the reasons that we talked about at the beginning of this video. You know, the caution is finally starting to show up in consumer spending. And I think it's going to be getting harder to sell just about anything, guys. Like, as inventory picks up in the for sale market like it has been, and as rental inventory goes up, that's not only going to drive prices down, but it's going to give people less fire under their skin to get out there and move when there's so many options available. You know, you don't have the pressure to buy a new house or rent a new place if you already have a good deal where you're at and supply is plentiful. And really the only good thing that these multifamily investors have going for them right now is the fact that buying a house is still financially unattainable for so many people. You know, not everybody has that six-figure income to go and buy that median $400,000 house right now. So really the only ace in the hole for these institutional landlords is the fact that everything's expensive, whether you're buying or renting still. And even though rents are starting to flatten out, they haven't really come down to the point where it has gotten $500-600 a month cheaper in most places. That really hasn't happened yet. So we're still waiting on that. Now, another thing that's been happening recently is Mark Zandi from Moody's Analytics. He's like their chief economist there. This guy's always in the news. He's scared to death right now of the Fed continuing to increase their interest rates because he thinks they're going to completely sink the economy. And I don't normally agree with anything that this guy says because he was somebody that said that home prices aren't going to come down about 8 or 9 months ago, which obviously was not true. But during the last few weeks, he has been begging the Fed to make sure that they don't do a rate hike at their next meeting. You know, their next meeting is between June 13th and 14th, later this month. And here's the thing, guys. The jobs report in May came out stomping the expectations, okay? It was at 339,000 new jobs for the month of May, and there was only expected to be 195,000. So that is a massive difference. And you know the Fed is going to take this into consideration because one of their number one goals right now, besides reducing inflation, one of their methods of getting there is increasing unemployment. And when they see these jobs reports, that's not a very encouraging sign for them to keep interest rates where they are and not do another rate hike, because clearly things are not slowing down enough yet. Now, you can be argued that most of these new jobs that are being added are, you know, low-level hospitality jobs and entry-level construction jobs, things like that that don't pay that much. And that's where the lion's share of these jobs are coming from, which is true. So this jobs report can be deceiving, and if the Fed is using this to decide whether or not they're going to continue with their rate hikes, it could be a little bit misleading, because things might look better than they really are right now with these jobs reports. But that's when I just laugh that you got so many people saying, oh, haven't you seen, you know, these jobs reports, the economy is so strong, you know, nothing can touch us right now. But they just look at the number. They look at, oh, there was 339,000 new jobs in May. They didn't look at what kind of jobs were added. They didn't look at how much the numbers have been readjusted over the past couple months, because that happens also. We talked about that about a month or so ago, and the real numbers after the adjustments can be quite different than the real numbers, guys. And if we're talking 100,000 less jobs than what they originally said it was, and combine that with the fact that most of these are jobs people don't want, that's not really a good sign for the economy. And you know, going back to earlier, talking about how so many people are afraid of unexpected expenses right now, another thing that people have to be worried about is insurance, guys. Because, you know, we covered already how State Farm decided that they were going to be leaving California and not writing any new homeowners insurance policies there. Well, literally a few days after that happened, it was confirmed that Allstate actually stopped writing new homeowners insurance policies sometime last year in 2022, and Farmers Insurance is joining these three big companies in no longer writing homeowners insurance policies in California. And they're all claiming this is because wildfire season is right around the corner, and the cost to build and replace in California is astronomical, as you can imagine. But for now, all these companies are still servicing their existing customers in the state. It'll be interesting to see if people are going to start getting dropped over there that have these companies, especially as soon as they go to make a claim. Because when you have your insurance company in the news telling you that they're not going to be writing any new policies, I would be very worried if I was a policy holder with them, if I did need to make a claim or something happened during wildfire season, even if it wasn't a fire, even if it was something regular, you know, a tree fell in my house, you know, is that going to be covered? Are you guys going to drop me? Now, they're saying there's still 100 other insurance companies in California that will still write you a new policy right now, but yet, of course, at a higher price. And State Farm is saying that they want to come back to California, but right now, in order for them to do that, they're pressuring the insurance commissioner to approve a $721 million increase in people's homeowners insurance premiums in order to come back, because that's the only way that for them writing these policies is feasible. Give us $750 million and we'll come back. So I think it's pretty normal for people right now to be worried about unexpected expenses, because these expenses are getting completely out of control, as you see. Now, it turns out that California does have an insurer of last resort when it comes to fire-prone areas. It's called the FAIR program, F-A-I-R, and it's very expensive, and it only provides bare bones coverage at best. So you're paying, you know, big money to get terrible coverage for your fire insurance over there. Already 300,000 people in California have had to sign up with FAIR insurance. This sounds like California is going to be going the way of Florida pretty soon, where they're going to be losing all these insurance companies, and homeowners insurance there is going to skyrocket for anyone who's left still writing policies. And you know, real estate's even more expensive in California than it is in Florida, so I can't imagine what this is going to do to the cost of owning a home over there. And speaking of insurance, let's move back over here to Florida, because there was some big news this week regarding Citizens Insurance, our homeowners insurance of last resort. And here's the thing, guys. Citizens now has 1.3 million homeowners insurance policies. That number has ballooned in the recent years. I think just a few years ago they had 500,000-600,000 policies, and now it's more than doubled in just the last 4 or 5 years or so. But this week, Florida state regulators approved for insurance to drop 26,000 policies right now. So you have slide insurance and loggerhead insurance. I never heard of either one of these companies that are going to be picking up the slack and taking these 26,000 citizens insurance policies, and this is all going to happen starting in August of 2023. So this is right around the corner. So if you have a citizens insurance policy right now in Florida, make sure you keep your eyes open on the mail, because you might be getting one of these letters letting you know that you're going to be forced to switch to one of these companies, guys. And the thing is, they can make you switch to these companies, because in December of 2022, the state passed a law that requires citizen policy holders to accept offers of insurance coverage from private insurance companies if the cost is within 20% of what citizens insurance premiums are. So if it's within 20%, you don't have a choice, guys. Like, you have to take it if there's another company that's offering you coverage. And that's exactly what they're trying to do now, is reverse so many of these policies, because they just have too many of them. And if we get hit with another major hurricane, Citizens Insurance is going to have to pour out, billions and billions of dollars, and that's going to make insurance go up throughout the rest of the state. They're going to have to put assessments across everybody's policy, making it even more unaffordable than it already is. They're trying to spread the risk, and if you're on this list of 26,000 people, you're probably going to be paying up to 20% more for your insurance if you get forced to switch. And I think this is probably going to be just the beginning of this. Now that they have this law in place where they can force you to switch if your insurance is within 20% of the cost of Citizens, and meaning it's 20% more, doesn't matter, you still have to take it. They're going to be trying to take more and more people off of Citizens and putting you on a new company that is willing to take on the risk, guys. So it sounds like the idea here is that this would make homeowners insurance more expensive for some people right now, with the hope that it might make it cheaper for everyone in the long run. But that is yet to be seen, how this is all going to work out. So going back to the original premise of this video, I think it's very smart for people to be overly cautious right now on what you're spending money on, because there are so many surprise expenses that could be coming up, especially when it comes to home ownership, which is what we mostly talk about here on the channel. And all the costs with home ownership are rising exponentially pretty quickly, guys. So you got to be ready for this stuff. If you want to be a homeowner, get ready to pay up, because it's not going to be cheap. That's for sure. If you enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.